Okay. So, yeah, so it is actually that part of the machine that you are using up during the year. Suppose you buy a lathe machine. So you presume that the lathe machine will run for say 10 years. After 10 years, you want to replace that or whatever you think that the life of the lathe machine is 10 years. That decision is yours, your prerogative to decide how many years the machine will go. If you are preparing the balance sheet profit loss account for the purpose of giving it to the bank and other external shareholders, if you are preparing the profit loss account and balance sheet for the sake of income tax department to estimate how much tax you have to pay, then income tax department has a list of assets and the rate of depreciation. You have to follow that meticulously, otherwise they are going to catch you. Well, this is sacrosanct, meaning you cannot change that. Whatever is given, it's almost like a rule, so you have to follow that. Now yeah, to understand it again from zero, depreciation is that component of the fixed asset that you show as expense to the extent you use up the machine. If you are using up 10% of the life of Xerox machine, or you are actually allowing 10% of procurement cost as depreciation during the year. Same with the lathe machine. Suppose lathe machine life is 10 years and you buy a lathe machine for 1 lakh rupees, then every year you think that you are using up 10% of the life of the lathe machine or 10% of the cost of the lathe machine, you will allow 10,000 as depreciation. Let's move forward. I'll not discuss too much because depreciation was introduced in the previous class. So there is this Xerox machine example just to drive home the point. Whose mic is creating noise? Who's Prithvirao? Prithvirao, your mic is creating noise. So now I think I have to share it again. See, so much of jhamela. No, it's there. Okay, so look at the example maybe in the evening. I won't go into details. You buy the Xerox machine for 5 lakh. There are so much of expenses like toner cost, paper cost, labor cost, electricity cost. You pay some rent. You have to give some maintenance expenses. So total cost become this. Now, by mistake, you estimate the profit without the cost of the Xerox machine, without including any component of the cost. And then you falsify to yourself that you have made a profit. If you include part of the Xerox machine cost, then you will realize that profit is not so much. Profit actually is less, or maybe you are ending up incurring loss. Here it is 30,000 loss in the year because you did not allow depreciation cost. Now, if you allow depreciation cost, it is going to be profit. So you should allow that, because at some point of time the Xerox machine will not be there, and if you don't allow that as an expense, you will end up pricing your Xerox machine, Xerox sheets at a lower price, because you have to do costing meticulously. On my left, you have allowed depreciation at the rate of say 50,000 or something. What is the depreciation is not given here, and it must be given in the next page. Suppose you are pricing it at 60 paisa. On the right, you are pricing at 50 paisa, and then you can see that you are making a profit of 50,000 here and you are not making a profit. Then if you allow, say, loss of value for the machine is 30,000 here, 30,000 there, and eventually a loss of 30,000, a profit. So you have to really take into account the depreciation for pricing to understand at minimum at what price I can give the service for photocopying. Somebody think that somebody does not take into account the depreciation. He will think that even if I sell at 50 paisa a piece, I am actually not incurring any loss. So to attract customer, he or she might price at 50 paisa. Whereas the other guy who knows that there is something called depreciation, if I price at 50 paisa, I shall actually incur loss. So he will price it accordingly and rightly. So Yeah, and any expenses that you incur, remember this is very important. Any expenses that you incur, in fact, you incur expenses of 100 types, more than 100 types. Every expenses is to be recovered from only one cash stream, that is sales. Sales is the only cash inward, cash coming. Other incoming cashes come for a different purpose. Like you raise a loan, cash comes in, but that has to be repaid. But sales is not to be repaid. Sales is sales. You are getting the money, and all the expenses have to be met out of sales. So whatever expenses you incur, you have to understand so that you can recover them from sales. And at the end of the year, you should see whether there is a surplus. If there is a surplus, you make a profit. If there is no surplus, there is no profit. So that is why it's very important to know depreciation and add that among other expenses so that at the end of the year, you have a realistic view about total cost and profit. Now, there are many methods of depreciation. There are many methods of depreciation. Don't worry about any of them except the two that is there at the top of this list. One is straight line method, another is declining balance method or declining value method or reducing value method. It is known by different names. One is straight line method. There is no other name, but another is declining balance or declining value method or reducing value method. There is something called sum of years digit method, unit of production method. All these you will learn later when you attend a finance course, not now. Now, straight line method is something like this. You buy a Xerox machine or say lathe machine. Now, suppose you buy the lathe machine for 10 lakh rupees and a Xerox machine for 5 lakh rupees. Now, suppose you think that this Xerox machine will run for only 5 years because this is a sophisticated machine and it may go kaput at any point of time. So you presume it's your prerogative. So you presume that Xerox machine will run for 5 years. And at the end of 5 years, I'm going to sell the Xerox machine for 1 lakh residual value. Maybe the company will buy back. There is a guarantee, warranty or something. Company says at the end of 5 years, you can sell it back to us at 1 lakh. So 1 lakh is called terminal value or salvage value, meaning the machine is almost like inoperative or something. This is the amount that you can salvage. On the other hand, for a lathe machine, suppose the lathe machine cost is 10 lakh rupees and you think that lathe machine is not so sophisticated, it will run for 10 years quite easily, and at the end of 10 years I am going to sell it for maybe 3 lakh rupees. 3 lakh rupees. So 3 lakh rupees is the salvage value, that is the residual value at the end of life. You can even say end of life value, no problem in that. So when that means you buy the Xerox machine for 5 lakh and you think that you will realize 1 lakh rupees by selling it. So if it has a 5 years of life, then you have to distribute the cost over this 5 years. But then you should not distribute the whole cost because you're going to recover 1 lakh at the end. So 5 lakh minus 1 lakh, that remains 4 lakh. So you have to distribute this 4 lakhs over 5 years. That means you're going to, your depreciation every year is 4 divided by 5, 4 lakh divided by 5, 80,000 rupees. So 80,000 rupees is the depreciation each year. And at the end of 5 years, you're going to get back 1 lakh rupees. So you recover the entire cost of the machine. That is the philosophy, that you have to recover the entire cost of the machine during its life, at the end of its life. On the other side, say you bought that lathe machine for 10 lakh rupees and its useful life is 10 years and the salvage value is 3 lakh. So this 3 lakh is not to be recovered over the years, that you are going to recover at the end of the life. So how much you have to recover? 10 lakh minus 3 lakh, that means 7 lakh. How many years? Over how many years you are going to recover? 10 years. So 7 lakh divided by 10 years, that means 70,000 rupees per year is the depreciation. That is how depreciation is calculated. And if you plot it, you will find it looks like this. That is why it is called straight line method. The value that remains looks like this every year if you plot. So that is why it is straight line method. Now, this is an example. It's not much. Say 10,000 rupees is the cost and say there is some salvage value. So say life is 5 years and salvage value is suppose 2 years. So you have to depreciate 8 lakh rupees. 8 lakh rupees over 5 years. So each year you have to depreciate 8 divided by 5. So it is 1600 rupees. 8,000 divided by 5. 16,000 every year. So equated amount. There is no difference of depreciation over the years. So first year, the value is 10,000 rupees. You have already recovered 1600. I said you are going to recover that cost in the form of depreciation. So 10,000 is the value. Then whatever way you have arrived at depreciation, that is different. You have arrived at 1600 rupees is the annual depreciation. So purchase price minus depreciation that you have already recovered, whatever remains is 8,400. So 8,400 is the book value at the end of this period. Just a second. I'm sorry. Sharad, I'm in a class. I'll call you back. Okay. So you're going to depreciate in 5 years, and every year you are depreciating 1600 rupees. In 5 years, you are going to depreciate 8,000. At the end of 8,000, you are going to recover 2,000 by selling the machine. That is called salvage value. Now, every year, at the beginning of the year, there is some value that you carry forward from the previous year. Now, this machine was bought during this year. So this year value is 10,000. Now at the end of the year, you depreciate by 1600, you deduct that, you get 8,400. That is the book value that goes to the balance sheet. I wish I could show you by writing on the board, would have been wonderful. Now this becomes the book opening value in the next year. So 8,400 becomes the opening value here. You deduct depreciation, same depreciation amount this year also, you deduct it from there, then you get 6,800 rupees. That 6,800 becomes opening value in the next year. You again allow depreciation of 1,600, you get 5,200 as book value at the end of the year. Likewise, at the end you see there are 2,000 rupees. This is the book value at the end of the year. This you recover by selling the machine. Okay, so everything is recovered. Now book value I have already explained. Now suppose I ask you a question in the class test that what is the book value of this asset at the end of, notice the term end, at the end of 3 years. So at the end of first year, book value is 8,400. At the end of 2 years, book value is 6,800. At the end of 3 years, book value is 5,200. So what you should do? You should know what is the cost price or procurement cost minus, if it is 3 years, at the end of 3 years, then 3 multiplied by annual depreciation. That is 1,600 into 3. It's 4,800. So 10,000 minus 4,800 is equal to 5,200. That is the book value. Hope you understand that. We will revisit that again and again while discussing more about depreciation. So at the end of 1 year, book value is 10,000 minus 1,600. At the end of 5 years, book value is 10,000 minus 5 multiplied by 1,600. So it is 2,000. Likewise, declining value method on the other hand depreciates at a fixed percentage. Straight line method, we depreciate at a fixed rate, 1,600 rupees every year. Whereas in declining value method, we depreciate at a fixed rate of percentage. So if I say that depreciation rate is 20%, so procurement cost is 10,000 multiplied by 20%, whatever is the value, that is the depreciation. So 10,000 multiplied by 20% is 2,000. So 2,000 rupees is the depreciation. What is the book value at the end of the year? 10,000 minus 2,000 is equal to 8,000. So 8,000 rupees is the book value. What is the book value after 2 years? So 8,000 is the book value at the end of 1 year. Then second year, your book value is 8,000 multiplied by 20%. That means 1,600 rupees is the depreciation. So 8,000 minus 1,600 is equal to 6,400. likewise. Every year it's going to change. Okay. Here there is no concept of salvage value because this asset will remain perpetually, meaning it will never become zero because you are depreciating at a fixed rate. So every year it is reduced by 20%. It will never become zero. So that is why there is no salvage value concept. Again, the same thing shown differently for reducing balance or declining value method. 10,000 rupees is the procurement price. In the first year, you allow depreciation at 20%. So 10,000 minus 2,000 becomes 8,000 rupees at the end of first year. This becomes the opening value in the second year. Just a second. Dashboard show present screen arrow option. Visible. I wanted a bigger arrow so that no. I have to learn. I wanted a bigger arrow so that my arrow is more visible. Okay, so next year, second year, your opening value is 8,000. Then you allow depreciation at the rate of 20% is 1,600 now. See, look at this. Depreciation also is reducing. Percentage remains the same, but it is reducing because book value is changing. So that is how book value is affected. It is also called written down value, book value or written down value. Okay. Now this has been explained, and I have juxtaposed two method of depreciation. Same value, 10,000 rupees asset cost, 10,000 rupees at asset cost. At the end of fifth year, the value is 2,000 rupees. This is the value, and at the fifth year here the value is this. So this is getting depreciated at a very lower rate. At the beginning, depreciation is more because here depreciation is only 1,600, here it is 2,000. Book value becomes 8,000, but then gradually depreciation reduces. It becomes 800 only. So the value remains more, 3,277. Here it is 2,000. This is of course accumulated depreciation. If you add all the depreciation every year, so that becomes accumulated depreciation. First year accumulated depreciation is 2,000 itself. Second year it is 2,000 plus 1,600, it becomes 3,600. Third year it is 3,600 plus 1,280. This becomes the accumulated depreciation. Let's move forward first. The distinction between the two is now apparent. A straight line method and this is declining value method. Straight line method, fixed amount. Every year 1,600 rupees is getting depreciated. Fixed amount for a particular asset. For another asset it will be different, obviously. But here only fixed percentage, 20%. Have to determine useful life. You need this information, how many years this asset will run. So if it is 5 years, you divide residual value by 5 years. Then here there is no concept of the life is perpetual and there is no concept of salvage value. There is no concept of salvage value. There is a concept of salvage value. So, and I hope you understand all this. So nothing big is there. This is just an example. So this is the same problem that we started. You pay salary, blah, blah, and then 1150 was the depreciation that we have shown here. Purchase price is 1,500 minus depreciation is 150. So whatever it becomes, that is depreciation. Now, if purchase price is 1,500, then depreciation is 150. So what is the book value? 1,500 minus 150, that is 1,350. This goes to the balance sheet. Here it is 1,350. Furniture or fixture. Earlier we were showing it as 1,500, but now because it has depreciated, that means it has lost value. So the book value becomes 1,500 minus depreciation, whatever is the value, this comes here. Machinery. Original value was 10,000 rupees minus depreciation was 1,000. So whatever remains is 9,000. That comes here as depreciation. That is how you prepare the balance sheet and look at this. Total asset is 80,995. Total liability is 8,995. So it is matching. By the way, I have modified that balance sheet in the previous presentation, and I have updated that in the video that was uploaded. So look at the uploaded video rather than a video at the messaging or chat box. Okay, and the total depreciation comes here. That is it. Amortization is exactly like depreciation, but for a different kind of assets. Amortization is also similar to depreciation, but it is applied to different kind of assets. Depreciation is applied on fixed asset which are not used up over a period of 1 year. You use it up over a period of more than 1 year. Okay, so you have to understand the distinction between fixed asset or depreciable asset and amortizable asset. Let me explain. Listen carefully, because I may not explain it again and again. Where we are, I don't know. No, I'm actually going very slow. I feel bad, but then I can't be faster. Now, let me explain amortization. Okay, any question till now? Let me have a break. Any question now?
Answer.
Yeah, ask. If you have a question, you can ask. Okay, I understand there is no question. There are questions, but you will get that slightly gradually, and then you can ask me question in the Excel sheet, please. If you have residual doubt, you ask question in the Excel sheet. Nowadays, I am finding it very difficult to find time. Nevertheless, I'll definitely try. I did not check the Excel sheet for a week or so. So till last week, there was no question. So I'll check if there is any question today, and then I'll answer it today itself. Now, amortization is like this. Suppose you spend, say, 10 crore rupees for research and development during this year. Say you are developing a vaccine or maybe a treatment for COVID vaccine, SARS virus. Now, you may end up incurring a lot of cost during this year, maybe 10 crore, maybe 100 crore. Now, if you whatever expenses you incur for research and development, you can show that as expense in your profit loss account. But if you show 100 crore rupees in 1 year as expense, then your sales may not be 100 crore, whereas your cost is 100 crore, you are going to show huge amount of loss. That is why normally we do not show all those big expenses in the same year. What we do, we capitalize them. We convert them into capital asset. That is called capitalization. How do we do that? We bundle all the expenses together and we show them R&D expenses to the extent not written off. Write off meaning showing as expense. If you are writing off, you are showing it as expense. So whatever amount you do not write off, you keep that in balance sheet and you name them as research and development expense, capitalized research and development expense to the extent not written off. You write off in the form of amortization. Let me give an example. Suppose you incur 10 crore rupees towards R&D this year. Now you don't want to show these expenses as expense. You want to capitalize. So the entire amount goes to the balance sheet in the form of capitalized R&D expenses to the extent not written off rupees 10 crore. Suppose next year, or you decide that from next year you are going to amortize that, meaning write off. So you think that 10 crore rupees can be written off in 10 years, then we are okay, meaning every year 1 crore rupees is fine. So every year you want to write off 1 crore. This is equivalent to saying that every year you are amortizing research and development expenses to the extent of 1 year. That is what is amortization. Another meaning of amortization is like this, or maybe another explanation. See, the outcome of this research and development will be enjoyed over a period of time, not in a year, because you have come up with a vaccine and you are going to sell that vaccine for maybe 10 years or maybe even more. So you are going to enjoy the benefit of this investment over a period of time. That means this cannot be a revenue expenses, meaning a current expenses, because the benefit will remain with you for a long time. As I defined, current expenses or operational expenses are those which are spent off or used up during 1 year. But this research and development expenses, even though we incurred it here, but the benefit will remain. This is another way of explaining. What is this noise coming?
The message has come, sir.
Okay, let me see if there is question. Entrepreneurial qualities and blah blah meeting. Is this analogous to cash burn rate? Is it today's question? Is this analogous to cash burn rate? Okay, no, this is not. Perhaps this is a relevant question. This is not analogous to cash burn. Cash burn is very different. Should I explain it now? Okay, let me explain because there is a question. Just I'm taking a diversion or digression. Cash burn is loss, cash loss, and it comes after all the estimation of profitability. If you remember, I estimated profitability as sales minus cost of goods sold. That becomes gross profit. Then gross profit minus operational expenses becomes operating profit. Operating profit minus interest expense becomes profit before tax. Profit before tax minus income tax becomes net profit. Now suppose the net profit is negative. Say you start with a sales of say 1 crore. Now suppose gross profit is say 10 lakhs. Now operating expenses is say 15 lakh. That means profit before tax is operating profit is minus 5 lakh. Now suppose if the operating profit minus 5 lakhs, and if you pay interest of 1 lakh, so minus 5 lakhs minus 1 lakh becomes 6 lakhs of profit before tax. That means loss before tax. Now we don't pay tax on loss, so there is no tax. So this becomes your net profit or net loss. So minus 6 lakhs is the net loss. Now suppose in this your depreciation is 1 lakh. So you reduce depreciation because depreciation is a non-cash expense that we normally don't incur. So we have not paid this money to anybody. So you add up depreciation to this. So minus 6 lakhs plus 1 lakh becomes 5 lakhs, minus 5 lakhs. This minus 5 lakhs is the cash burn. This minus 5 lakh is the cash burn. You burn cash to this extent every year. Okay, so you remember this. This is recorded in the video. I might very well give a question on cash burn because I took time to explain. You should know this, and if there is residual doubt, you should tell me. Amortization is very different. Amortization is you have incurred some expenses. You don't want to show that within operating expenses. You have the option to show all the expenses under operating expenses except interest. But then you have decided that because research and development expenses are too large, we don't want to show it in the same year we incur more because we are going to enjoy the benefit maybe over a period of 10 years. So we are going to distribute this and amortize this over a period of 10 years. So if the cost is 10 crore, we are going to amortize 1 crore every year. That means we are going to show 1 crore among operating expenses as amortization. We'll come to that. I'll give you an example very soon. So here it is given profit before tax, before that depreciation and amortization. Gross profit minus salaries, depreciation, amortization, other operational expenses, then you get operating profit. Minus interest, you get profit before tax. Minus income tax, you get net profit. Minus dividend, you get retained profit. But before dividend, with net profit, you add back depreciation and amortization to get cash profit. I have not shown it here, but maybe I'll show it somewhere. Okay, so far, so much about depreciation and amortization. Now we are going to understand owner's equity, because the moment you start balance sheet, first thing that comes to our mind is owner's equity. Suppose you start a business. Suppose you talk to two more friends and you decide that, okay, let us start a business. This is start a startup. You go to STEP IIT Kharagpur and tell the MD that, sir, we are going to start a business and we want to incubate our idea here and then move forward. The STEP MD is going to tell you that you have to have a private limited company to be incubated here, because that is the rule of STEP. So you want to register a company. Now to register a company, you have to have a name. You cannot give a name. If you are free to give a name, then many will be naming their company as IIT Kharagpur. That is not allowed. There is a system of naming companies. So you have to really apply for a name. There are authorities where you have to send at least 3 names, 3 alternative names, and they will pick and choose. They will search the first name. If they get, they will say, yes, you can go ahead and start your company with this name. Only then you buy the domain name. Otherwise, buying the domain name at the beginning will lead you to some problem, because if you don't get the name, you have to change the name drastically, and then buying the domain name will be useless, because company name and domain name will not be the same. So suppose you have the name. The next thing is to decide, or even before that, you have to decide who brings in how much money, who is going to hold how much shares, what percentage, and what are the roles and responsibilities. Okay, so this question will be faced by everybody whenever they would like to start a company. It's better that you understand it now. So when you want to register a company, after you get the name, ROC is going to ask you this question, register of companies. It's going to ask you first question, what is your authorized capital? So try to understand what is authorized capital. Then next question will be, what is paid up capital? Reserves and surplus comes later, which we'll discuss later. But know that there are 2 kinds of capital. One is authorized, another is paid up. There may be something called partly paid up that you will understand automatically. Authorized capital is the outer bound, upper bound to the extent you can raise capital. Suppose you have authorized capital of 50 lakh rupees. That means all your co-founders can bring in up to 50 lakh rupees. That up to that extent you are authorized. If you want to bring 51 lakh rupees or more, beyond 50 lakh, then you have to approach to register of companies to increase the authorized capital. Only then you can bring in more money. But even if your authorized capital is 50 lakh, it is not necessary that you have to bring in 50 lakh. The minimum amount for floating a private limited company is 2 lakh rupees. So you can have authorized capital of 50 lakh, but paid up capital of 2 lakhs, because you have brought in only 2 lakhs. 3 of you found that we don't have a lot of money in the bank. So maybe somebody said, I have 1 lakh, so I'll be bringing 1 lakh. Another guy said, I have only 30,000. So he brings in 30,000. Other guy says, I have 70,000. So you have 1,70,000 and 20,000 as total paid up capital. But that you have already paid up. That money should be there in a current account of the company, not in your personal account. So you have to have a current account in the name of the company. Then you put in all the money that you want to bring in. Suppose you decide that all will bring in equal sum. Suppose paid up capital is 3 lakh. Each of you bring 1 lakh rupees each. So 1 plus 1 plus 1, your paid up capital is 3 lakh. Now, what is your percentage holding? Your total capital is 3 lakh, not 50 lakh. 50 is authorized. That doesn't come to the picture when you estimate percentage holding. You have brought in a total of 3 lakh rupees. Somebody brought in 1 lakh. So 1 lakh divided by 3 lakh, 33.333%. So each of you will be holding 33.33% in the share. That is your ownership percentage. So understand what is ownership percentage. Now suppose, hypothetically speaking, your paid up capital is say authorized capital is 15 lakh or 50 lakh or whatever, but suppose paid up capital is 10 lakh. Now this share actually is defined by number, not rupee alone. So there will be some number of shares, and it is your prerogative to decide what should be one share equal to. You may decide that one share is rupees 10. Some other party, other company, not party, other company may decide that their share will be only 1 rupee per share. Even some party may decide that our one share will be 88 rupees or 57 rupees or 100 rupees. It is up to them to decide what should be. This is called face value or par value of a share. So here par value or face value is 10 rupees. So we have 10 lakh paid up capital that consists of 1 lakh shares of rupees 10 each. So it becomes 10 lakh rupees. Now suppose you three friend A, B, C. A has brought in 5 lakh rupees. So he is supposed to get 50,000 shares of the company. 50,000 multiplied by 10 is 5 lakh. So he brings in 5 lakh, divided by 10 is 50,000. So he gets 50,000 shares. Another brings in 2 lakh rupees, gets 20,000 share. Another brings in 3 lakh rupees, he gets 30,000 shares. Now you divide that by 1 lakh. 20,000 by 1 lakh is 20%, 50%, 30%. That is the distribution of shares. Now comes the more interesting part. This is the picture. The top is the picture that you three guys have started the business. It is A, B, C. Total holding is 100%. A is holding. My God, I didn't put the percentage. Just a second. Let me put the percentage here. Data level. Okay, so A gets 20%, B gets 50%, C gets 30%, depending on amount of money. A brought in 2 lakh rupees, so 20%, 5 lakh rupees, 30 lakh rupees. Now, after this is the initial stage. Now, after a while, you need money and you have approached to an investor, and the investor is ready to invest 1 crore rupees. How the valuation is done, I will talk about it later. So the investor, angel investor, tells you that, okay, I'll bring you 1 crore rupees that you need, but I want 20% of the company. I want 20% of the company, meaning 20% of ownership. So how is it decided, and how you three guys will distribute the remainder of the equity among yourselves? That is the question. So first part, the beginning, before money, meaning before the angel brings in the money, you were holding 30, 20, 50% or 20, 50, 30%. Now the guy comes in and he says, he or she says, I want 20%. This picture, the guy wants 20%. So you guys, you three will get the remaining 80%. Who gets what will be decided from here. This remaining 80% will be shared among three of you with this percentage, 20, 50, 30. So 20% of the 80% will be held by A, which is 16%. 50% of the 80% will be held by B, which is 40%. 30% of the 80% will be held by C, which is 24%. So it will look like this. Angel holds 20%, that's what he wanted. Then A will hold only 16% now, B will hold 40% and 24%. Look at the original picture and look at this. You are holding 20, 50, 30. Now you are holding 16, 40, 24. Angel is holding 20%. Okay, that is how your percentage will vary. You can extrapolate. Now suppose another investor comes in after a year or so. Now he says, okay, please don't mind my he and she. In US, they normally say she, but he are majority. So I try to maintain he and she both, but that kinds of hinders. So don't mind if I say he to the ladies in particular. Now, suppose the angel says that new angels or maybe VC, the company comes and tells you, I'm going to invest 10 crore rupees in your company, but I want 15% of the company. The VC says they want 15% of the company to bring in 10 crore. Forget about the 10 crore. That doesn't come in the picture of estimating percentage. So the VC says that we want 15%. So now you're going to do it all over again. Like here, what we did here is here. We angel 20, ABC like that. So you just copy this or something. Need not be. So let us estimate that. It will be a good exercise. I never wanted to do that, but let me do that. So any kind of residual doubt should go off. So we just try to draw this. We have the Excel sheet. Now, suppose the first guy is the VC guy now. VC. So he tries to bring in whatever. Forget about that. He wants 15% of the share. Now you have, let me copy it here. The angel has 20% and A has 16, B has 40, C has 24. Now we will be after 15%. How much is left? We are left with 85%. After 15%, we are left with 85%. So A will, or say angel, old angel will get his is equal to his 20% multiplied by the remaining 85%. So this has to be shown. Oh my God, that makes a huge thing. Now I need to convert that into format cell, then number, then or maybe percentage. Where is that? Fraction, currency number. So it should be percentage actually. Where is that? Okay, I'm not able to do that. So I have to learn that. So it is 17%. Similarly, A is supposed to get is equal to, he is holding a 16%. Okay, oh, I have to convert that into percentage multiplied by this is equal to this. So this should be actually convert that into a decimal. Okay, so then it will be okay. Now B is supposed to get 40% of 85, supposed to get this. Then C is supposed to get is equal to 24% of 85%. So he gets 20%. Now if you sum them off, you will find they are 100%. Should I use the summation? Oops. Is equal to sum. whatever that is, it's 100%. Just forget about this. But I have to really put the data back to its original health. Oh my God. Yeah. So forget about this. Now, copy, paste values, forget about all those external data, otherwise we may end up making, now you can make a sum. So we don't need this anymore. Now see, it has already come. So your holding will be like this. I have to put the level. Yeah. So Angel, sorry, BC gets 15%. Angel is reduced to 17%, then 13, 34, 20. So that is how the percentage changes. I took a lot of trouble doing this. So please learn it. Don't ignore it. I'm going to put a question on this definitely in the test. So learn it completely. Okay. Now, just before we move to another topic, meaning the main profit loss account, let me just introduce another thing. Maybe it was a good idea to do it later, but just let me, suppose you sell a machine during a year, and if the book value is something, but you sell it at a very different price. Suppose the book value was 2000 rupees, whereas you sold it for 2400. That means that machine is giving you profit. I'll go back to the lathe machine example. Suppose the lathe machine was 10 lakh rupees value. First year the depreciation was 1 lakh. Second year it was 2 lakh. Third year it was, and again 1 lakh, sorry. Accumulated depreciation was 3 lakh at the end of 3 years. So book value was 7 lakh rupees, because 10 lakh minus 3 lakh is 7 lakhs. Now, suppose somebody comes and you agree that you will sell the lathe machine to him for 8 lakh rupees. 8 lakh rupees, even though book value is 7 lakh. That means you actually are making a profit of 1 lakh over book value. That goes to profit loss account as profit for sale of fixed asset. Here in the profit loss account, you show that as profit by sale of fixed asset. Whereas suppose the machine is not performing so well, and that is why you have decided to sell, then you may incur a loss. Suppose the end of third year, your book value is 7 lakh, and the guy says, I can buy it only for 5 lakhs. I won't give you more than 5 lakhs. That means you are incurring a loss of 7 minus 5, which is equal to 2 lakh. So that 2 lakh will come here as loss, as expense. Earlier it was adding to profit, add profit from sale. Now it is subtract loss from sale. So you subtract this from profit. That becomes the thing. I think that should be pretty much everything today. This is about cash flow. I'll try to, this you can understand after today's lecture. You will understand it more. And whatever is this, should I do it today? I'll do it tomorrow, maybe, if time permits. Otherwise, I'll do it later. So I'll stop sharing this. I'll share something else and try to quickly do this part. Okay, I have only less than 10 minutes. Now, I started this in the previous lecture, that this is the data for operational data and some balance sheet data. Operational data for the year 2021 and some balance sheet data as on 31/3/20. As you might remember, that balance sheet refers to a particular date, whereas operational data, profit loss account, cash flow refers to a period like 2020 to 21. Okay, so 1st of April to 31st March next year. That is the period. So during the period, you paid a rent of 6,000. During the period, you incurred advertisement expenses of 3,000. Likewise, these are some of the expenses that you have incurred. You should know which are operational expenses and which are balance sheet item. even though we spend money to buy equipment, this is not expense, this is a cost. This will be recovered over a period of time because equipment will remain with us more than a year. So that is why it is not operating expenses. Remember this. This is fixed cost. It's a balance sheet item. Salary we pay and forget about it during the year. So this is a part of operating expense. Closing stock, it remains with us. We are yet to consume that. It remains as closing stock. During the year, we buy and sell, we consume. But at the end of the year, this remains. That is why it is not part of operating expenses. Transportation is part of operating expenses, maintenance, legal expense. But purchase of goods go into gross profit. Purchase of goods go into, what is it? Gross profit. Okay. Closing stock, goods available for purchase here. Very much close to that. Oh, I wanted a thicker line, but there is no dashed thicker line. Get this? Purchase of goods is used for estimating gross profit. That is why it is not part of operating expenses. Construction of factory shed, long-term asset. Purchase of truck, long-term asset. That is why these are not part of operating expense. Whereas if you hire a truck for transporting something, you pay the money immediately, you forget. That is why truck hiring charge is part of operating expense. Similarly, amortization is also part of operating expense. Remember this, amortization is also part of operating expense, just like depreciation. Repayment of bank loan, this is repaid separately. This is not part of your business expenses. You have to make profit. From profit, you repay bank whatever you borrow. That is why this is not part of operating expense. Trade receivables is a balance sheet item that remains at the end of the year. Whatever you are supposed to receive from customers, that's a balance sheet item. Telephone bill payment is an operating expense. Electricity bill payment, operating expense. Purchase of telephone remains with you for more than a year. So this is a fixed asset or a long-term asset. Interest on bank loan is not fixed asset, but this is deducted after estimating operating profit. That is why this is not part of operating expense. Closing a stock, again, or closing cash in hand, this will normally not be given. You have to estimate that using cash flow statement. I have given it for convenience. That is a balance sheet item. Insurance, operating expense. Audit fee, operating expense. Fresh long-term loan is not part of expenses nor income. Loan is not part of operating expense nor income. It comes in cash flow statement. Trade payable, again a balance sheet item. Traveling expense, operating expense. Stationaries, operating expense. Company pays dividend to owners. That comes after you estimate net profit. So obviously you don't include them in operating expense. Founders contribute new equity, comes after you prepare everything. Just before preparing balance sheet, it comes. So obviously it is not income or expense. Company pay income tax at the rate of 30%. You have to estimate only after estimating net profit before tax. Outstanding and short-term loan is a balance sheet item, so don't worry about it now. Okay, so everything is classified. Now you have to start estimating the depreciation. How do you appreciate depreciation? You have to estimate depreciation based on their value, not their original book value, but book value plus anything that you have added or subtracted. I'll show you only two items. One is building. You have to go to the previous year's balance sheet to see whether there was any building asset. Okay, land is never depreciated, that comes as it is. Building, earlier year it was 1000. Now you have to see whether you have, just a second. Okay. Okay, so your building value was 1000 rupees. Now you have constructed a factory shed, which is nothing but building. So you add them, total becomes 1300. You have not sold any building asset, so total becomes 1300. And I have given that building is depreciated at the rate of 5%. So 5% of that becomes 65. You deduct 65 from here, you get 1235. That becomes the new book value of fixed asset. It is written here in the balance sheet. That is how balance sheet is prepared. Okay, automatically. Then machinery, previous year's value. Machinery, previous year's value was 6800. I have given an arrow for you to understand. Then you have bought new machinery worth 1200. Where is that? Here, 1200. So add that. Then you have bought 2500 rupees worth of truck. Truck also is fixed asset, so it is also comes under machinery, so it is added. You bought another telephone for rupees 20, so you add that, total value becomes 1400, 520. So add all of them becomes 21,320. And then you sold a machine for 2,400. Sold old machine for 2,400. That is to be deducted from the subtotal. You get 18,920. That you did depreciated 10%, becomes 1892. What is left is the book value of machinery that goes to the balance sheet here. Okay, 1702. It is given with an arrow. Now this is one depreciation, this is another depreciation. This total becomes the depreciation. So at somewhere you have to have that depreciation written, so that, yeah, total depreciation is this. This will go into your operating expenses for estimating the profitability that I will show tomorrow. Okay, thank you very much. If you have